GB economy here. Quick clarification before anything else. If you see accounts copying this format, this tone, this structure, pushing courses, paid memberships, trade signals, that is not us. It has never been us. GB economy does not sell access. We do not sell indicators. We do not sell inside information. What we do here is simple and it is consistent. Raw data, structural analysis, and context the mainstream financial media won't connect for you. That's it. This channel exists for financial warfare education, understanding how markets actually function beneath headlines, beneath narratives, beneath noise, not to tell you what to buy, not to give you entry points, not to promise outcomes. If you're here for signals, you're in the wrong place. If you're here to think independently, verify primary sources, and understand the mechanics driving capital flows, then you're exactly where you need to be. We break down primary data. We track structural shifts. We connect macro forces to real asset pricing without hype and without agendas. If you want to stay ahead of the narrative, instead of reacting to it after the fact, subscribe and turn on notifications. The next move in this cycle won't be announced politely on mainstream television. It will show up first in the data, and that's where we operate. Mexico matters, not politically, structurally. In 2023, Mexico produced roughly 6,400 metric tons of silver, about 25% of total global mine supply, according to USGS data. 1 out of every 4 ounces comes from Mexican soil. That is not trivia, that is concentration risk. Now layer in the current security escalation, military mobilization, localized airspace closures, disrupted transport corridors, and cartel-related operations concentrated in key regions. Mining does not shut down overnight. Output data for February and March have not yet shown a confirmed production decline, but supply chains do not need to collapse to create pricing pressure. Silver is already running a structural deficit. Global demand exceeded mine supply in both 2022 and 2023, with above-ground inventories tightening and COMEX registered stocks trending lower year over year. In a tight physical market, uncertainty itself becomes a pricing input. Logistics delays, shipment bottlenecks, insurance risk repricing, these are enough. Markets reprice risk before spreadsheets update, and at $84, the paper market is still assuming normal flow from the world's largest producer. That is the misalignment. Silver is not currently priced for a supply shock. It is priced for stability. Now layer in the gold-backed crypto signal. As of Sunday evening, February 16th, before Western futures markets reopen, PAXG, the token-backed 1-to-1 by allocated physical gold, is trading roughly $50 above Friday's COMEX close. Spot gold ended the week near $5,098. PAXG is pricing closer to $5,148, while traditional desks are offline. That spread matters. Crypto markets trade 24/7. There is no Sunday close, no waiting for Asia, no waiting for New York. When participants cannot access futures or spot markets directly, they express positioning through tokenized proxies. What you're seeing in that $50 premium is capital bidding for gold exposure during illiquid hours. That is information, directional information, not certainty. Weekend premiums can fade once institutional liquidity returns. Gaps fill. Arbitrage closes spreads. Thin order books exaggerate moves. One instrument's pricing does not dictate Monday's settlement, but ignoring it would be a mistake. It is an early read on sentiment before the broader market reopens. If that bid carries into the futures session, the technical level that matters is last week's high, specifically the February 12th intraday peak. That is the structure. A decisive break and hold above that level signals momentum continuation. A rejection there signals exhaustion. We are not predicting, we are observing. In tight physical conditions, with macro stress building, even a weekend proxy can offer a forward glance at how aggressively capital is positioning before the bell. One critical variable most traders will overlook on Monday, February 17th. Shanghai remains closed. The Shanghai Gold Exchange reopens Tuesday. That matters because China is the largest physical gold consumer in the world and one of the dominant forces in silver demand. When Shanghai is offline, a major liquidity center is removed from global price discovery. What you're left with is thinner participation during Asian and early European hours, followed by a Western open without full cross-market arbitrage pressure. Thin liquidity changes behavior. It amplifies moves. A $40 or $60 upside gap in gold during reduced volume conditions can look like breakout confirmation when it is simply order book imbalance. The same applies in reverse. A sharp $30 pullback in the first hour of COMEX trading can appear like failure when it is merely spread compression as liquidity normalizes, volume validates, liquidity contextualizes. Without Shanghai participation, price can travel further, faster, on less capital. This is where traders make timing mistakes. Strong movement is not the same as structural confirmation. A breakout during thin conditions must hold once full liquidity returns. Until Shanghai re-engages on Tuesday and physical flows resume normal pricing influence, Monday's volatility should be treated as condition-driven, not thesis-confirming. Now focus on silver's structure. As of the last close, spot silver is trading near $84. The immediate upside objective on the lower time frame is $86.30, a level that aligns with a prior weekly high and a visible liquidity pocket on the daily chart. That alignment matters. When a technical extension and historical market memory converge at the same price, it creates confluence. Confluence increases probability, not certainty probability. Above $86.30 sits the more critical zone, $87.20 to $89. This is not a random range. It marks the area where prior rallies stalled and supply entered the tape aggressively. Order flow previously flipped there. If silver approaches that band again, the response will tell you everything. A decisive move through $87.20. With expanding volume and sustained bids above $89, signals momentum, continuation, and short covering. That is strength. But if price enters the zone and starts compressing small candles, declining volume, repeated rejections, that is absorption. And absorption at resistance drains momentum fast. This is structural analysis, not a trade call. We are identifying levels where behavior changes. Markets do not move in straight lines. They transition through liquidity nodes. $86.30 is the first test. $87.20, $89 is the proving ground. How silver behaves inside and beyond that range will determine whether this move expands or exhausts. Now we move to the anomaly that sits beneath the surface, the February COMEX gold contract. With 4 trading days left before last notice, open interest still represents approximately 436,000 ounces, roughly 13.5 metric tons of gold. At this stage in a standard delivery cycle, open interest typically collapses as shorts roll or close positions. Instead, current positioning is running about 24 times higher than the historical average for this point in the contract. More unusually, February open interest is exceeding that of the upcoming March contract, something rarely, if ever, observed in normal term structure behavior. That pattern raises a structural question. When elevated open interest persists into delivery, it often signals a concentrated short that has not exited. In a liquid environment, that position would unwind through volume, but recent daily volume has been thin, insufficient for orderly distribution at this size. The implication is straightforward. Either the short has access to deliverable physical metal, or it must source it quickly. In past delivery stress episodes, including periods preceding major enforcement actions and large bank settlements in 2020, bullion banks have stepped in during final notice days to issue deliveries and stabilize the structure. That does not guarantee disruption, but it confirms this: February's positioning is statistically abnormal. In a tight physical market, abnormal positioning becomes risk. Step back from the charts and look at the monetary architecture. According to IMF COFER data released in late 2023, the U.S. dollar's share of disclosed global foreign exchange reserves has fallen to roughly 58%, the lowest level in over 30 years, down from above 70% in the early 2000s. That is not noise. That is structural drift. At the same time, central bank gold purchases have accelerated. In 2022, official sector gold buying exceeded 1,000 metric tons, the highest annual total on record. In 2023, purchases remained historically elevated. More notably, for the first time since the mid-1990s, central bank allocations to gold have outpaced net additions to U.S. treasuries. The inflection point was February 2022, when approximately $300 billion of Russian foreign reserves were frozen following the Ukraine invasion. That event recalibrated risk perception globally. Reserve assets once considered politically neutral were revealed to be conditional. When reserves can be sanctioned, they are no longer pure safety instruments, they are policy tools. The consequence is measurable. Sovereign buyers diversify. Gold demand rises. Treasury demand becomes less automatic. For decades, persistent foreign purchases of U.S. debt helped absorb deficit expansion and export inflation abroad. As that mechanism weakens, a greater share of monetary expansion remains domestic. That is not ideological. It is arithmetic. Reduced external absorption increases internal price pressure, and the steady bid under gold reflects that recalibration in real time. Now add the geopolitical layer. Diplomatic language does not equal risk removal. As of early February 2024, negotiations around Iran's nuclear program have shifted tone, but U.S. military positioning in the region has not meaningfully reversed. Carrier strike groups and additional air defense assets deployed to the Middle East in late 2023 remain operational. Force posture tells you more than press releases. Hardware does not move at that scale without contingency planning. Markets understand this. Geopolitical tail risk is rarely priced in full, it is priced as probability. Gold, and, to a lesser extent, silver function as insurance assets when escalation pathways remain open. A temporary de-escalation narrative does not eliminate strike risk. It reclassifies it from imminent to conditional. That subtle distinction matters. Part of the premium embedded in precious metals today reflects unresolved strategic tension, not certainty of conflict, but acknowledgement that the downside scenario has not been closed. Now the counterweight, because discipline requires it. Thin liquidity, particularly with Shanghai offline on February 17th, can manufacture false breakouts. A $40 upside gap in gold during reduced volume conditions is not the same as sustained institutional accumulation. Liquidity gaps create traps. We have seen that repeatedly during holiday sessions and post-expiry weeks. Second, Mexico's security escalation has not yet translated into confirmed mine shutdowns or export data disruptions. There is risk. There is not, as of today, a documented production decline. Markets can price in fear quickly and just as quickly unwind it if logistics normalize. Third, COMEX delivery stress has precedence. In prior episodes, including periods surrounding major enforcement actions in 2020, bullion banks stepped in during final notice days to issue deliveries and prevent disorderly squeezes. Abnormal positioning does not automatically equal systemic failure. And finally, long-term price projections calling for triple-digit silver or five-figure gold may be structurally coherent over multi-year horizons. But timing separates thesis from profit. Being directionally correct does not guarantee capital survival. Direction and timing are different skills. Confusing them is expensive. As of mid-February 2024, multiple structural variables are converging at the same time. Mexico, responsible for roughly 25% of global silver mine supply, is facing security instability that introduces logistics risk into an already tight physical market. PAXG traded approximately $50 above Friday's $5,098. Gold closed before Western futures reopened, a directional signal emerging during off-hours liquidity. February COMEX, gold open interest remains near 436,000 ounces into the delivery window, statistically elevated relative to historical norms. At the sovereign level, central banks have purchased over 1,000 metric tons of gold in recent annual totals, while the U.S. dollar's share of global reserves has fallen to multi-decade lows near 58%. Individually, each factor is manageable. Together, they form alignment. Supply uncertainty, early premium signaling, delivery stress, structural sovereign demand, gradual reserve diversification away from the dollar. That combination is not noise. It is pattern formation. Does that guarantee immediate upside? No, but it defines the environment. Markets transition when pressure accumulates across multiple fronts: physical, monetary, and geopolitical. That is what we are observing now. Thank you for watching. If you see this differently, if you disagree with the structure or the interpretation, share your perspective in the comments. Intelligent disagreement sharpens analysis.